we have direction, we have market structure, liquidity, point of interest, the introduction to the class. We have the second class, which is the what? The other point of interest that we make use of and the rules in picking a proper point of interest. The third class, we have the different types of liquidity that we have and how to take our profits using those types of liquidity. Then the first session, we have directional bias. Now, most people are maybe in a hurry to, maybe people that are looking for signals. I don't give signals. We're here to learn. So it means that until classes are done, you probably shouldn't be trading a real account because you can't just know everything that's required to know about this concept and this strategy just by being in one class. Then trading market structure and the rest without having a clear understanding of directional bias can also affect you because not knowing where the market is going to will affect your decisions in picking a right point of interest for your trade. So just have patience and pay attention to the class until I'm done with everything I have to do. Also, don't be faster than your shadow. Don't ask questions about things that are yet to be taught because trust me, I've taught a lot of sessions before you guys. So I already know the questions and everything that revolves around this particular topic, and I'm going to teach everything. Everything that you feel like you can possibly need for this strategy, I'm going to teach everything. So don't be faster than your shadow. Just learn at the same pace that I'm teaching you guys. So without further ado, let me just start the class. I'm about to share my screen. Can you guys see my screen? All right. So the strategy that I trade is a concept called market structure liquidity point of interest. It's basically a part of SMC, but my own logic behind it. So it's market structure, liquidity, and then point of interest. Now, talking about market structure, the definition of market structure is basically simple. I want to just, this is not a beginner's class, but I want to start with my own view on how I look for market structure before we can move on to the more complex things. So market structure is basically the current flow of the market, the pattern prices to approach one point or the other. That is what market structure is all about. Now, there are three ways that price makes its movement. When market is moving from point A to point B, it's either moving using one of these patterns. First one, we have the uptrend. So price is either we're trending to the upside by making a series of higher highs and then higher lows, higher highs and then higher lows, higher highs and then higher lows. An uptrend is made up of a series of what? Higher highs and higher lows. It means that every high that comes out will be what? Will be higher than the previous one. We have this high. The moment that price makes a higher low, the next high that will come out should supersede the previous high, which is this. And the next low that comes out should still be higher than where the last low was. The next high that comes out will be what? Higher than the previous high. And the next low that comes out will also be higher than the previous low. That is what an uptrend is all about. This is one way that price makes its movement. The second way that price also makes its movement is what you call a downtrend. The downtrend is when price is consistently making a series of what? Lower highs and then lower lows. That is market doing lower highs, then lower lows, lower highs, then lower lows, lower highs, then lower lows, lower highs, and then lower lows. This is what a downtrend is. Any low that comes out is going to be lower than the previous existing one. This is a low. The next low will be lower than the last low. The next low will be lower than the last low. The highs will always be lower than the previous highs. This is the last high. The next high will be lower than the previous one. The next high will also be lower than the previous one. So that is what a downtrend is, when price is making a series of what? Lower highs and then lower lows. This is also another way that price also makes its movement when it's moving from one point to another. Then the third way that price also makes its movement is what you call a ranging market. Now, market ranging means it's moving from a fixed point, basically consolidating from one fixed point to another. So price going from what? Support to resistance, resistance to support, support to resistance, resistance to support, support to resistance, resistance to support. These are the three ways that price makes its movement. Either it's trending to the upside or trending to the downside or is ranging or consolidating. Are you guys with me? Can you all hear me? You guys are following me up. Okay. So this is just the introduction to market structure. How price actually makes its movement is this. Now, when it comes to market structure, there are two concepts that I pay attention to for market structure. There are two phenomena that I pay attention to when it comes to trading market structure. And it's the concept of what? Reversals, and then the concept of what? Continuations. When price is at any kind of trend, whether it's trending to the upside or to the downside, or price is ranging, there are two things you are fixated on. You're either waiting for price to give you a strategy to continue trading for a continuation, or you're looking for a way to join in for a reversal. What it means is that if you have an uptrend and price is giving you higher highs and then higher lows, higher highs and then higher lows, higher highs and then higher lows, and you see a clear uptrend, you're either looking for two things, either for price to continue going to the upside or for price to reverse and start going to the downside. So the concept of markets continuing the current trend is what you call a concept for continuations. Then price what reversing the current trend to the other direction is what you call the concept of reversals. Now, the concepts that we use in trading reversals is what you call a market structure shift. And then the concept we use in trading continuations is what you call a breakout structure. Now, when it comes to a market structure shift, market structure shift is defined as what? As the indication that the current trend that price is on is ending and the new trend is about to begin in the opposite direction. Market structure shift is an indication that the current trend that price is on is ending and the new one is about to begin in the opposite direction. Now, when it comes to representing it graphically, this is what it means. It means that because when price is on any particular type of trend, it is giving you a particular pattern. For example, if it's an uptrend, the pattern is what? Higher highs and higher lows. Now, any deviation from price making higher highs and higher lows, then it means that a market structure shift just occurred. For example, an uptrend is what? Made up of higher highs and then higher lows. Higher highs and then higher lows. Higher highs, then higher lows. But the moment price now makes like a higher high, then comes down here, instead of making another higher low to continue pushing to the upside, it takes down this former low here. This is just an indication that a market structure shift just occurred. So down here will be your market structure shift. Yeah, that's your market structure shift. So market structure shift is basically the indication that the current trend that price is on is ending and the new one is about to begin in the opposite direction. It means that whenever a market structure shift occurrence happens in the chart, whichever trend that market is on, you're going to start looking for trades in the opposite direction of it. Same thing as this downtrend. The downtrend is made up of what? A series of what? Lower highs and then lower lows. This is it. Lower highs, lower lows, lower high, lower lows, lower highs, lower lows, lower highs. Then the moment lower lows, then the moment price comes up here, instead of making another lower high, so price can continue selling to the downside. If it takes out this last high in the market, then this means that a market structure shift just occurred here. Some people call it a change of character, but the general name for it is just a shift in structure. So this is what a market structure shift. So on the charts is something like this. The concept we have here, we had there's basically this lower highs and lower lows concept. Towards the end of the chart here, it started getting the trend started ending. You can see the lower highs, you can see the lower lows, you can see the lower highs, you can see the lower lows, you can see the lower highs, you can see the lower lows, you can see the lower highs, you can see the lower lows. Then price came here, and what did it do? It took out this last high. This is what an example of a market structure shift. So a market structure shift is basically the indication that the current trend that price is on is ending and the new trend is about to begin in the opposite direction. Whenever a structure shift occurs in anywhere, it means that whichever trend that market was previously on, before that structure shift occurred, you have to now start looking for trades in the opposite direction of that trend. Another example of that is something like this. We have an example here, market giving us for lower highs, we have lower lows. We have lower highs, we have lower lows. We have lower highs, we have lower lows. We have lower highs, we have lower lows. Then price came here. Instead of making another lower high to continue the market selling down, what did it do? It took out this last high. What does this mean? It means that a market structure shift just occurred right here. So whichever trend that market was on before, you have to start looking for trades in the opposite direction. Meaning that since this was a previous downtrend, we're now going to start looking for trades to the upside. So that is the concept of what market structure shifts. Basically, the indication that the current trend that price is on is ending and the new one is about to begin in the opposite direction. Hope you guys are following me up. Are you guys following me up? So that is the concept of market structure shifts. Whenever you get a market structure shift, whichever trend that price is on is going to end, and the new trend will begin in the what opposite direction. Now, another example of that is this: you have this clean uptrend. You're having your higher highs, you're having your higher lows, your higher highs, 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 your higher lows, your higher highs. Then price eventually came. And if price is about to break any zone, you have to make sure that it closes below that zone with a body, with a candle body, not with the wick. So as price actually took down this low and closed here with a candle wick, that was where we got our market structure shift occurrence right here. So the market structure shift occurrence is just an indication for a trend change. Like if you notice, after price gave us the structure, what happened next? Price eventually started selling, but you don't just jump in for a sell immediately. You get that structure part of your strategy. We have other concepts like the liquidity concept, then your point of interest, and so on. So the structure part of it is just to determine the direction you're going to be trading the market. So for example, if you had a previous uptrend, this question is for you guys. If you have a previous uptrend and the market structure shift occurs, where are you going to be targeting to trade next? Like which direction are you going to be trading? If you have a previous uptrend, a market gives you a market structure shift, which direction are you going to be now trading? Exactly. It's going to be what? To the downside. Exactly. It's going to be what? To the downside. So whichever trend that you had the market on, whenever a structure shift occurs, the new direction of the market is going to be opposite of that previous trend. So if you had a downtrend and the market structure shift occurred, the new direction of the market is going to be what? To the upside. And if you had a previous uptrend and the market structure shift occurred, the new direction of the market is going to be what? To the downside. That is the concept of a market structure shift. Now, that is the concept for trading what? Reversals. That is the concept of trading what? Reversals. Now, after that, that is what? One of the concepts of your structure part of your strategy. Now, the other concept for the structure part of your strategy is the concept of trading continuations. Now, the concept of trading continuations is what you call a break of structure. Now, unlike a market structure shift, whenever a break of structure occurs in the market, you are still going to be looking for trades in line with the current direction of the market. A break of structure is basically a scenario when price keeps breaking key levels while maintaining its current trend. For example, if you have an uptrend, a market is giving you higher highs and higher lows, higher highs and higher lows, higher highs and higher lows. All these highs that market was breaking while it was making these higher highs, when it makes these higher lows, all these highs that price is taking out, all these are key levels. All these are key levels. The high here, the high here, the high here. And the process of market breaking all these key levels is what you call a break of structure. Now, whenever a break of structure occurs in the market, you're still going to be looking for trades in line with the current direction of the market. We have a bullish trend. Once market keeps breaking structure to the upside, we're still going to maintain looking for what? More buys, meaning that market will only just give you an opportunity to join into a buy after a break of structure. If market gives us a break of structure, what it will do is what? To pull back and give us a retracement, you look for what? Another buy. Do you see? So a break of structure is a scenario when price keeps breaking key levels while maintaining its current trend. So in this situation here, this is what an example of a break of structure. This is an example of what? A break of structure. This is an example of what? A break of structure. This is an example of what? A break of structure. But the moment that price comes and then fails to continue and then takes out this low, this is an example of what? A market structure shift. I don't really pay attention to trading every break of structure that I see. I've posted this thing before. I said that when it comes to break of structures, I pay attention to the structure that takes out more than one zone. When a structure takes out more than one zone, that is what you call a double break of structure. All these ones that are taking just this high and this high and this high out, all these are what you call single break of structures because they are focused on taking out just one zone. The one I pay attention to trading, the one that I will see and I will say, okay, I've picked out the continuation part of my strategy, is when I see price give me a double break of structure. A double break of structure is when market takes out more than one zone. Let's assume there happened to be like a high. Let's say there was a high here. Let's say there was a high here. Let's say the high was right here. Maybe let's say it's a resistance level. Let's say this is a resistance for price pushed down and then started the uptrend. So this is what an existing high on the chart in the market. An example of that is here. If you check right here, you can see a resistance level here. This is a high. So the moment price continues making this uptrend, making these higher highs and higher lows, it makes a higher high, it makes a higher low, takes out this high. This is what? A break of structure, but it's what? A single break of structure because it's what? It's just taking out one zone. This is what? A break of structure. But the moment price comes, makes a higher low, during the process of taking out this high, it also takes out this formal existing resistance level here. This is an example of what? A double break of structure because it took out more than one zone. The moment this happens, this is when I can actually start looking for the next part of the strategy in order to join in the continuation trend of this uptrend. All these single break of structures, I don't look for trades when price gives me a single break of structure. I only look for trades for continuations when price gives me a double break of structure. When it takes out more than one zone, that is when I look for what? For continuation trades, for break of structures. But if it's a market structure shift, the moment price takes out any low or any high in terms of structure shift, I just mark it out immediately. But when it comes to break of structures, I would want price to break more than one level. That would give me enough conviction that the momentums that these buyers or sellers are putting into the market is actually increasing rapidly. So I would want to continue trading in that direction of the market when I get a double break of structure, when price takes out more than one zone. Hope you guys are following me up, please. Okay. So an example of the double break of structure right here on Ethereum, we had this uptrend already, market giving us these higher highs and higher lows, higher highs and higher lows, higher highs and higher lows. But the moment that price came here and took this high out, we're also taking out this formal resistance level here. This is a clear example of what? A double break of structure. When I see this, this is the only time I will pay attention to looking for a trade in what? Towards the upside. I wouldn't look for any trades to the upside if I did not get this double break of structure. If it was just this single break of structures, I wouldn't be looking for ways to join into the buy. It was only when price took out this resistance plus this high here. That is where I got what? A double break of structure. This is when I can now start looking for the next criteria that I will use to not take my trade. But the thing is that with the point of interest that I will teach in this particular class, you can't actually trade double break of structures with it. Break of structures mostly confluence with breaker blocks. I will talk about what a breaker block is in this class, Shabo. In the next class, that's when we'll get deep into it. So when it comes to picking POIs, your breaker blocks, they work mostly hand in hand with breaker structures. Then the market structure sheet mostly works hand in hand with your other blocks. But it does not really matter whichever one you see. There are rules in picking a point of interest. So whichever one that price gives you, you can use that. So now, that is the concept of your structure part of your strategy. We have just two concepts: the concepts for trading reversals and then the one for trading continuations. The one for trading reversals is what? Your market structure shift. And the one for trading continuations is what? Your double break of structure. Double break of structure. Another example of a double break of structure is actually here. You can clearly see this uptrend. You can clearly see what? This uptrend. But we have this former resistance level here. And then this high here. So when price took this high out and this former resistance, this is a double break of structure. This is when I will get more confirmations to join a buy. That was why after price gave us this, it came back to retest, and then that was where the massive buy started from again. So when you get a double break of structure, it actually gives you more confluence to look for trades in line with the current trend of the market. But it's not just taking traders of the immediately that happens. There are POIs that we'll pay attention to. We're going to get to the POI part of it later. But I just want to just deeply explain this part of it, this structure part first, and make sure you guys understand it. So do you guys understand the structure part of this strategy now, right? With what I just taught you guys. Okay. Okay, and that means if you're still having difficulties, the class is recorded. So you watch the class later, and everyone does not really learn at the same pace. So if you're having difficulties, the class is recorded. I was in recording after classes. You watch the recording, you back test, you practice, you will understand it. Trust me. So now that we are done with the structure part of the strategy, it is now time to move to the next part of the strategy. Is the liquidity part of the strategy, because it's made up of what? Structure, liquidity, points of interest. So you take it consecutively. You don't just jump. You don't look for liquidity first and look for structure second and look for point of interest. No, you look for structure part of it first. You look for the liquidity part of it second. Then you now look for the point of interest third. So now, when it comes to the liquidity, there are different types of liquidity that we have in the markets. But the liquidity that I pay attention to when it comes to picking the point of interest part of the strategy is what you call inducement liquidity. Now, an inducement is what is the first valid pullback that price gives you after a market structure shift or a double break of structure. Your inducement is the first valid pullback price gives you after a market structure shift or a double break of structure. Now, what I mean by a valid pullback is something like this. Let's assume that we have a downtrend. Then price gives us what? A market structure shift. After that, the inducement should be price giving you a retracement towards the direction that market shifted structure from, before eventually moving into that same direction you shifted structure into. And it will also be preferable if you can actually cause another break of structure up here. This is your inducement. If it's the concept of double break of structure, let's assume there was a formal resistance level here, then price started making higher highs and then higher lows. then this is a break of structure. You don't look for inducement from single break of structures. No, you pay attention to inducement after price gives you a double break of structure. So let's say higher highs, higher lows, higher highs, higher lows. But the moment price takes out this resistance and then this high here, that's what a double break of structure. This is when you can start looking for an inducement. So the first pullback that price will give you before pushing back up again to take out the last high, that is what your inducement is. It's not every time that it takes out the last. Sometimes it can just come here, just be equal to the last high, then come back again. When this happens, this can also be your inducement, provided that price gives you that retracement and pushes up close to at least where the last high was, or it can just break. Only a few times it doesn't really break the high, but majority of the time it breaks the last high or the last low. So this is an example for the double break of structure. If it's a structure to the downside, you can have higher highs, higher lows, higher highs. So you can have higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, then price gives us a market structure to the downside. Once you've confirmed that structure shift, you can now look for inducement. You don't look for inducement before a structure shift. You don't look for inducement before a double break of structure. It's only after a double break of structure or after a market structure shift, that's when you can now look for your inducement. Meaning that you should expect price to pull back up before going back down. This retracement, this pullback is what your inducement is. The inducement is a trap